Hello and welcome back to the Geordie Pig Investor channel, where we delve into the world of dividend investing to help you build a portfolio that pays you. Whether you're just starting out or looking to maximise your passive income, this channel is your go-to resource for strategies, insights and the tools you need to grow your wealth steadily over time. Hit that subscribe button and join me as we explore how to make your money work for you, one dividend at a time. UnitedHealth has just had one of its worst quarters in its entire history, and Wall Street is punishing the stock. But while the market panics, I'm buying. In this video, I'm breaking down exactly why I just bought some shares in UNH, what the market is getting wrong, and why I believe this healthcare giant is setting up for a major comeback. If you're looking for long-term opportunities hiding in short-term chaos, you're in the right place. Let's get straight into it. UnitedHealth Group is a major US healthcare company offering health insurance and services through its UnitedHealthcare and Optum divisions. As of 2024, it ranks amongst the largest companies by revenue and is the largest healthcare company globally by revenue. Some key stats to do with UnitedHealth Group: they are based in America, part of the healthcare industry, have a market cap at $267 billion, went public back in 1984, have over 400,000 employees, have a 15-year dividend growth streak, a 5-year dividend growth rate at 11.7%, and a very tasty yield that currently sits at 2.88%. Over the last 6 months, as you can see on the graph, they have performed very poorly, being down 49.41%, and that's what we're going to have a further look at today. First up, let's have a look at some key reasons for UnitedHealth Group's stock decline, with the first one being the surging medical costs. The company faced higher than expected medical expenses, particularly within the Medicare Advantage plans. This was attributed to a surge in post-pandemic care utilization as many seniors resumed elective procedures. Consequently, UnitedHealth's medical loss ratio rose to 85.2% in Q3 of 2024, up from 82.3% the previous year, indicating a larger portion of revenue spent on medical care and impacting profitability. As well as this, there was the regulatory and legal challenges. UnitedHealth is under investigation by the Department of Justice for potential Medicare fraud, specifically concerning overbilling practices in its Medicare Advantage program. The company alleged inflated bills by mining old medical records for additional diagnosis, leading to increased scrutiny and potential financial penalties. As well as this, we had the leadership turmoil, the abrupt resignation of CEO Andrew Whitty following a series of setbacks, including the fatal shooting of UnitedHealthcare CEO Brian Thompson, has raised concerns about leadership stability. Former CEO Stephen Hemley has returned to lead the company, signaling a continuation of existing strategies amidst growing scrutiny over its business practices. We also have the cybersecurity incident. A significant cyber attack on UnitedHealth's Change Healthcare division in February 2024 disrupted electronic payments and medical claims proceedings, leading to widespread operational challenges and financial losses estimated at $2.24 billion after tax benefits. And there was their reimbursement and policy changes. Changes in Medicare reimbursement rates and the implementation of the V28 payment formula have adversely affected earnings, with projections indicating a 13.5% decline in 2025. Additionally, increased scrutiny of the company's pharmacy benefit management and pricing models has compounded financial pressures. And what sort of impact has this had on the stock? Well, as you can see on the graph, they are now down over 50% in only a 1 month period. These challenges have led to a significant loss in market value, with UnitedHealth stock experiencing its steepest single-day decline since 1998. The company's market capitalization has decreased by over $190 billion in 2025 alone. This reflects investor concerns about its ability to navigate the complex regulatory environment and maintain profitability. So you might be thinking, why have I just opened a new position in this company in my portfolio? Well, you'll be pleased to know that is exactly what I'm going to be telling you right now. The first reason why I bought into UnitedHealth Group is due to their analyst confidence and upside potential. Despite recent challenges, many analysts maintain a positive outlook on UNH. UBS and Oppenheimer have retained their buy and outperform ratings respectively. So although they have revisited their price targets to around $400, this is still well above that current price at $291, which leaves a lot of room for potential upside. And to back this up further, the reputable Morgan Stanley maintains an overweight rating, attributing recent issues to short-term cost pressures rather than structural problems. There's also their oversold technical indicators. Technical analysis suggests that UNH may be oversold. The stock's Relative Strength Index, RSI, indicates oversold conditions following a sharp decline between 50 and 200-day moving averages. Recent trading volumes have been the highest since 1998, suggesting strong institutional activity. We also have their leadership stabilization. The return of former CEO Stephen Hemley is seen as a stabilizing factor. He was the CEO between 2006 and 2017 and oversaw the stock more than triple in price. So it's not surprising to hear that analysts have expressed confidence in his ability to navigate the company through these current challenges. And we have the long-term growth prospects. Despite short-term setbacks, UnitedHealth's diversified business model, including its Optum division, positions it well for long-term growth. The company's extensive experience in infrastructure and healthcare services provide a solid foundation for recovery and expansion. And finally, we have the most important one for me, and that is the insider buying. 3 directors have bought over $1.5 million worth of shares after the news broke out, and it had a huge dip in price. Not only that, the owner, John Rex, has bought $5 million worth of stock, and the new CEO, yes, the one we were just talking about, has actually purchased himself $25 million worth of stock, equating to 1.7 million shares. So if that doesn't give you some confidence in the company, then I really don't know what will. That's over $30 million worth of UNH stock bought since the news broke out by insiders, and when insiders are buying their own stock, it signifies confidence in the stock, and to me, this shows the Medicare fraud may not be as bad as we initially thought. Next up, we're going to have a look at their free cash flow. Over the last decade, UnitedHealth Group has demonstrated a strong, steadily growing free cash flow profile, underlying its operational efficiency, scale, and strategic capital discipline. We can see that in 2023 it hit a record high FCF, reflecting a maturing, highly cash generative business model, particularly in Optum. Since then, it has had a slight decline due to a spike in care utilization, especially in Medicare Advantage, cyber attack related costs, and operational disruptions, but as a whole, this is still a very impressive 10-year FCF, and having a very impressive FCF payout ratio at only 31%, meaning they have so much room to continue reinvesting back into the company, buying back those shares, and paying out those dividend payments. This is even more exciting when I show you their dividend history chart. As I am a dividend growth focused investor, one of the main things I'm looking for within a company is for it to be showing consistent dividend growth. One way to see this is by looking at the company's payout throughout the years to see if it has been raising that dividend payment on a year-to-year basis. As you can see on the chart, UNH has demonstrated consistent growth over the past 10 years, going from paying a dividend yield of $1.88 in 2015 to paying a dividend now of $8.18 in 2024. Not only this, but due to the recent dip in price, the yield's sitting at close to 3% right now, which is the highest it's ever been, making the stock look even more attractive, especially with that 15-year dividend growth streak. Now we're going to have a look at some different valuations methods for the stock, with the first one being their intrinsic value. To calculate the intrinsic value, you combine the relative valuation and the DCF valuation, and what I like to do is come up with the worst, average, and best case scenario when I plug my numbers in. The worst case scenario, we can see that UNH was valued at $509.22, which would be a 43% undervaluation on that current price. On the average case, they were valued at $629.56, which is an undervaluation of 54%. And on that best case intrinsic value, they were valued at $904.65, which would be a massive 68% undervaluation on that current price. I not only look at the intrinsic value, but also like to look at something called the Wall Street estimates. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. For a company the size of UnitedHealth Group, they have multiple analysts looking at the company on a daily basis. And as we can see, they are still very optimistic over the next 12 months for this stock, with their lowest valuation being at $494.90, which is a 70% upside on that current price. Their average forecast being $560.91, which is a 92% upside on that current price. And on the best case, they believe it could be worth $710.85, which would be a massive 144% upside on that current price. From this, I now have my 3 valuation methods so I can combine them to get my best, average, and worst case scenarios to see if they are trading at an attractive price right now. On the worst case, it is believed they will be worth $502.06. So with a 10% margin of safety on this price, you'd be looking to buy the stock at $452. And with a 20% margin of safety on the worst case price, you'd be looking to buy UNH at $402. On the average case, being valued at $595.24. So with a 10% margin of safety on this price, you'd be looking to buy the stock at $535. And with a 20% margin of safety on this price, you'd be looking to buy the stock at $475. And then finally, on that best case price, they are valued at $807.75. So with a 10% margin of safety on the best case price, you'd be looking to buy the stock at $727. And with a 20% margin of safety on the best case price, you'd be looking to buy them at $646. What does this mean for the company? Is the stock a buy right now? Well, I personally initiated a position in UnitedHealth because I believe the current sell-off has created a rare opportunity to buy a world-class business at a significant discount. Despite recent headwinds, including rising Medicare costs, regulatory scrutiny, and a cyber attack, the company's long-term fundamentals remain exceptionally strong. UNH continues to generate robust free cash flow, has a sustainable dividend payout, and operates in an industry with durable, long-term demand drivers, aging demographics, healthcare digitalization, and managed care expansion. The return of former CEO Stephen Hemley adds confidence in leadership stability, and technical indicators suggest that the stock is oversold, with analyst price target implementing an over 60% upside from those current levels. In short, I'm buying into a temporarily troubled but structurally sound market leader with massive cash flow, proven management, and long-term growth potential. This is a classic buy the dip opportunity in a blue chip compounder. So that is why I bought shares in UnitedHealth Group right now. The short-term pain is going to be for the long-term gain. If you found value in this breakdown, do me a favor, hit that like button, subscribe if you're new here, and let me know in the comments, are you buying the dip or staying on the sidelines? I'm dropping weekly deep dives on high conviction plays, market trends, and portfolio strategy. So make sure you turn on those notifications so you don't miss the next one. Thanks for watching, and as always, stay smart, stay patient, and stay invested. Until next time, this is the Geordie Pig Investor, over and out.